Thanks very much, Brett. So I think you've probably already introduced your panel, but just to repeat, on your left, everyone, Raz Bouyan, who's Portfolio Manager and Director of Wavestone Capital, who's spoken at a number of ERA conferences over the years. Thanks very much for joining us again, Raz. And I understand you had a company meeting this afternoon, so thank you for joining us. To his left, could I introduce Will van der Pol, who's now CEO of Market Forces. Congratulations on that appointment, Will. And last but not least, Anthony McDonald, who's one of the Sean Ticklier columnists for the Financial Review. Thanks very much for joining us, gentlemen. Over to you, Brett.
Great, and thank you from my perspective for coming on. So Will, maybe if I can begin with you. Can you walk us through the approach you typically take when you're looking at a company and you're seeking to affect change? And what I'm specifically interested in is the kind of engagement program you would undertake. And I think as a subset to that question, if you're thinking about where you start from, what does success look like from Market Forces' perspective in terms of how you engage with companies?
Great. Well, to understand that, we probably have to start from where we're coming from. So Market Forces is a 12-year-old now, not-for-profit advocacy organisation, engaging with the finance and corporate sectors, seeking to shift the flow of finance to drive a rapid transition to a decarbonised economy. We do that to support our charitable purpose, which is to protect and enhance the natural environment. And of course, to do that, we take a view of the most the biggest threats that are posed to our environment, and that obviously centres us around the expansion of the fossil fuel industry and the need to transition to renewables. So that's where we're coming from. I think it's really worth also acknowledging that is not diametrically opposed to value-based activism. So values and value, I don't think, are this kind of dichotomy that it's one or the other. It may be that we take a different view as to when risks are likely to materialise, and I guess how a company is addressing its exposure to transition risk and perhaps the timelines that they are working towards is where we might see a difference. But really, the science is clear around where the best outcome for investment portfolios is, and the science around the physical and transition risks that are posed to individual companies as well. It's very clear that the lowest economic harm is done by the lowest warming scenario. So there's a lot of alignment there and a lot of overlap. How we approach it is we start with research. So Market Forces is a research-based organisation. We conduct research to understand where the biggest fossil fuel expansion and therefore new emissions threats lie. We started in Australia, so this is often a supply side conversation, but increasingly we've grown to work across the Asia Pacific region, which brings in demand side as well. So we'll do research across a value chain. I think the LNG value chain is probably a really useful example. So from a producer like Santos we spoke about before, through to a pipeline company like APA, LNG export infrastructure, shipping, LNG import infrastructure in places in Asia, and particularly the threats from emerging Asian economies. And so looking at a country like Bangladesh with a significant proposed expansion of gas power to be fuelled by LNG imports. So we research that value chain and understand the corporate and financial actors that are playing within that, and then go about engaging with them.
So how early in that process would you engage with the company itself when you're looking at a specific situation? Give us a sense of that, if I could ask that.
It would be at the point that we've identified them as the one of the most critical players that we think can make an influence and a change. So a change to policy or strategy at that company that would see a real world emissions reduction, which is what we're coming at it from. So once the research is done, then the company engagement begins, as does the engagement with retail shareholders, institutional investors, financiers, so whether debt providers to that company as well. and media and other sort of stakeholders as well.
Right. So on that point of media, I'll switch to Anthony, but I do want to pick up that point later on in the discussion around the intersection of value and values-based. There's been a couple of sort of explicit examples of where that's occurred, but I think to start with then, picking up on the role of media as Will alludes to, Anthony, you've notably written on several high-profile activist situations. I think of everyone I can think of in the media world, you've probably got the best sense of the dynamics that are at play. In my presentation earlier, I maybe pejoratively put the view that the media and activists had sort of a sense of sort of almost a symbiotic relationship, and certainly clients often feel that activists get something of a rails run in terms of their arguments in the press, and you often have to educate in the context around why that's the case. But putting that aside, what would you say to that contention, and what's the nature of your interaction when activists come to you with a viewpoint?
Yeah, no, I think it's true, Brett. I mean, I'm not going to deny it. If you look at what the media, like the core function of the media and what we're trying to do is hold people to account, right? It's to ask tough questions of powerful people. It's to try and encourage debate. It's to probe. It's to push for change, hopefully to make things better at the end of the day. Now, in a corporate sort of context like business, what we do, that's asking CEOs tough questions. It's putting things to chairman, and that makes us, I guess, like-minded in a way to activists, right? So when activists turn up and they're doing the same thing, they're prodding, they're pushing, they're trying to make change for good, or in their mind, or just make money. For sure, we are naturally going to be interested in that. And if I look at the companies in your presentation, Endeavour, Helios, Lendlease, Woodside, Ramsay, I've written way too many columns on those in the past 2 years. Like you just can't help it. And from where we sit, lots of things can make a good story, but conflict is always one of them. And that's because you can get a healthy debate. You can get the potential to make change that's good, that's lasting, and that's what we're here for at the end of the day.
I think I might bring Raz into the discussion now, and Raz, I want to caveat again that everyone understands Wavestone's not an activist. At the same time, I think it's fair to say you're known for being relatively robust in your opinion, not afraid to voice that both to companies, but also in some recent examples, put that publicly as well. So I think you bring a very good perspective on that. So if you think about some of those cases that Anthony mentioned, or others that might be on your mind, what would be the point where you would say, actually, I'm not happy with this situation, I've engaged with the company, I'm actually going to put that perspective through the media?
Yeah, that's a good question. As I've gotten older, I think I've become more direct. I've always been direct, by the way, and that's partly why kind of most boards and management speak to me, because they know I come from a good place. And I think that's the essence of our business, to be honest. Between Kath and I, Catherine Altree was my partner. I think we've, over the course of many, many years, have had relationships with some of the key people who've been successful in industry, and that's a privilege for us. Like, we get to come into work and talk to some of the brightest and smartest, and you go back home and you actually have a profitable business. So it's actually a really good thing when it works. It's interesting of that lot that you had up there, and I'm sure there's a few there which are obvious. The thing that brings kind of us into a place is where we've actually got the trust of the board and management. So we are not activists. I mean, Anthony would have rarely spoken to me about a stock which, and there's a few there was Endeavour, there was Ramsay, they were both companies that we've owned. We've tend to prosecute our case in a private setting, and therefore a lot of the stuff that we do never gets aired. We're not in the business. We obviously, if you think about our business model is we've got the savings of the Australian population through superannuation or through retail funds. They entrust us in a fiduciary capacity to basically deploy those savings into Australian companies that can grow, and the wealth grows. So the ideal example of that would be supermarket shelf person. That's how I see it. That's reason for being, really. A supermarket, kind of someone who's taking shelves, is basically invested in a particular superannuation fund, and they choose us as an investor in amongst their Aussie equities funds. And so our job is for that person who's making, I'm making the numbers up now, let's say 50 or 60 grand, who basically gets to a retirement age and has actually got a corpus which they can use to do the things that they want to do with the savings, right? That's our job. But to be able to do that, you need corporates who are basically held to account, exactly to Anthony's point, and to basically have good capital allocation and get to the end point where we can create that corpus. It's pretty simple. It's a theory of compounding, really. And fortunately for us, there's not that many people with common sense that can do it consistently and generate that wealth for the end investor. And I think if you follow that through, ultimately everything we do in business is with the lens of the end investor, because that's why we've got jobs. That's our reason for being. Once you set that up, it's very easy to have a tough conversation with a management team or a board, knowing fully well that these people know you from, that it's not like a confrontation. You're essentially telling them what you think is right. And I'll call out people like Bob Every, he's going to be 80 soon, by the way. And you go back in history, and what happened in Australia was the two strikes rule. Before the two strikes rule came on, and I can't remember, it was 96 or whenever it came on, before that, you try and get hold of a chair or an NED, you had no chance in hell. No chance. They would go, why would we speak to a shareholder? Right? That was where we were coming from. And the two strikes rule happened, and then you started seeing the chair coming in to see us. And Bob would see us before that, by the way, Bob's special. But then they had to come and see us at least once a year. And then the REM committee person happened, and so you had the REM person come in alongside and so I just had a meeting with Santos, for instance, and Keith was there with the head of REM to talk about Kevin's pay. But that's really when it started off. The two strikes rule was a big thing for Australian corporates, I think, and I think for us as shareholders. And then, obviously, I used to be at Colonial, and Kath and I, so we basically, at that point in time, we were the equivalent of being Aussie Super. So they'd all turn up because they needed us. So it was like a self-interest thing. And then I think over time that's evolved. And so you go now, and you've got basically a situation, and I'd use Ramsey as an example. I'm sure Kelly's sitting somewhere in the audience, but that was a classic, right? You knew that there was bad governance there. We knew it, and and we are very direct. So Michael Siddle, there was a 20% shareholder, which was the Ramsey Foundation, and Michael was a good mate of Paul, and he was obviously, part of the foundation, was the chair of this company, and they had two representatives on the board at that point in time, and I basically wrote to them saying, listen, we're going to vote you down. It's just wrong, because you're getting bad capital decisions. And by the way, he was and sorry, I was got to be careful here because these people are rich people, they come for you. But he had $200 of stock, which was, in my mind, I looked at the transaction, I couldn't find it, so I just assumed that he was gifted. So it's very hard when you've been gifted stock to actually hold the management to account. So it was just completely compromised. And so when I wrote that, he, in fairness, came and saw us alongside another director who I won't name. And then we were told, he's got all the corporate memory, he's got to keep going. And the stock was $66 or whatever. And we'd already lost money on it because the stock was actually higher. And then once we realized we were not getting anywhere, the easiest thing for us to do is to sell and move on. So in that instance, we sold all our shares, and I wrote them a letter, a very nice letter, saying, thank you so much for the engagement and stuff. Clearly, you don't share what we share, which is the outcome that we wanted was the changes and not to put more capital into France and Benelux and UK and just run your hospitals in Australia. And so we got out. And I think that case is interesting because what we told them 6 or 7 years ago, they've effectively gone and done now. They've changed the board. David's on the board. He's obviously changed the CEO. Natalie's come on. And today, if you go and see Natalie, the same stuff that we actually said 7 years ago is actually coming true. So, and I'm not saying we're the smartest guys. It's a very easy industry to understand. There's, nuances. But that's a classic case of where if you actually listen to people like us, then we might be wrong. And so many times Bob would tell me, like, this is just crap, right? He's just making stuff up. Like, that's fair. You have that conversation. But the flip side of that, though, from a corporate, like Bob's a good, the reason I use this example is he was the chairman of Wesfarmers and he was the chairman of Boral. And they run this corporate confidence index, and he'd be like number 1 for Wesies and number 20 for Boral. He goes, Raz, I'm the same guys. You guys are just full of shit, basically. That's what he'll say. You guys don't understand. Like, I'm the same person. How can I be one and that? So there's like lots of compromises that you make. But in more recently, what's happened, and this is where I'll finish because otherwise I can keep going. What's happened with us, and this is something that most of you experience, is the market structures have changed. Yeah. So there's a bunch of us, like I actually joke with our clients saying like we're kind of a dying breed, like we, active managers, not activist managers, but active managers. And then you've got all the growth of passive, and you've got the pods and the citadels who'll be there in a share for 2 minutes. Like, it's so there's this difference between how we think, and there's a broader bunch of the active community. You're trying to own businesses for the reasons that we're trying to create wealth for people, but there's a whole bunch of people who just think it's a ticker. Right, they'll be there for 2 minutes, something happens and they just go. So it's very hard for you guys in the audience to actually appreciate that the markets have changed, and then you put on top of all of that, the passive. And the example I'll use there is Rio Tinto, which is why I was in the papers, is they've got a resolution now. Rio is listed in Australia as well as in the UK. The UK listing trades at an 18% discount to the Aussie limited shares. Exactly the same economic entity, just different setups. And so there's this activist hedge fund called Palliser Capital, who I caught up with recently, and they've effectively said, you've got to merge them, put a resolution into the UK. UK is about 77% of stock. Australia is 23% of stock. So there's 4 times as many shares listed in the UK, which is trading at an 18% discount to the limited. So their argument is, you just collapse the structure, it's great for everyone, and that discount will close, which is fair enough. Like, that's absolutely sensible from their perspective. But as a limited shareholder, I go, for the first time in a long time, Rio's actually in a really good place in terms of growth relative to BHP, because they've got Oyu Tolgoi, which is a copper mine coming on. They're suddenly getting earnings from outside of the Pilbara. So the franking that's actually stored in Rio, which is about 9.2 billion, that's actually franking credits, which, as the offshore earnings grow, they can frank dividend for Australian shareholders. But the issue is, ISS is a global entity, right? They've got limited shareholders and they've got UK shareholders, but there's one recommendation. The dude who's written this report that we should actually vote for it sits in Europe. He's a special situations guy. He's got nothing, he doesn't know anything about the business. And he's written up this thing saying, yeah, it makes logical sense. Let's just say, you should vote for it because the company hasn't given you enough to say that, we shouldn't do it. So they've kind of ticked and said, we should vote for that resolution, which is only advisory in the sense that it tells you what needs to get done if we, whether it's the right or the wrong thing to do. The second mob, CGI, the guy's in the UK, he's come up with his kind of solution, whereas the CGI can have different recommendations. And so we're sitting there thinking, my God, this is scary because we're going to end up in a bad place because this whole merger is actually really bad for limited shareholders. And so we're sitting there going, how are we going to fight this? And so this is a test case for me to see if people actually wake up to it. And I've kind of obviously canvassed all our asset owners and stuff to see that they don't just tick a box and then we get, because typically what will happen is, Rio Tinto operates in 35 jurisdictions, and most of them are frontier countries. It's countries like Mongolia, Chile, Argentina, and they all have tax regimes. And the thing with these companies is Rio's put in 15 billion US into Mongolia. It's their biggest asset, like that's going to be the biggest revenue for them, and it's like the big chunk of their GDP. Typically these countries, once you build a massive copper mine there, it's not like you can run away and take the copper mine and put it in the Pilbara or wherever else you find copper. So I just feel like there's going to be so much leakage of shareholder value if this gets to anywhere near where these guys want us to go to. And the tragedy of all of this, and this is where I've got a very strong view, as I said to the guys, I said, you'll be there for 2 minutes. The discount will close, you'll be gone. Like I've had real shares for like as long as I've been an investor in large caps. So I think there's this dichotomy there. So you've got to be really, really careful with this stuff. But I think the market structure changes are making it really hard, and for people like us to have a bigger.
I would agree with that. I think there's the rise of passive funds on the one hand in terms of the market the constituency of the market, at the same time unlisted private equity capital there as well, both of which for different reasons are almost exacerbating or driving more activism in the market for that reason.
Yeah. So we're being forced into that.
Yeah. So there's a few things. Well, firstly, I'm a big fan of Bob Every as well. Member of that fan club. I should disclose I also work for David and Natalie at Ramsay, and fantastic company doing great things and listening to the market, I should say. I wanted to pick up on one other point you made, and I'm going to throw this to Anthony, in terms of thinking around, in this market, the role that industry funds play, but also I know that Raz was talking about it in a different context in terms of that what is effectively a global transaction, but the role of proxy advisors too, because in activist situations, both of those are playing a pretty critical role. So when you look at these situations, what are you seeing in that regard?
Yeah, I think that the industry funds, just through the sheer weight of their holdings, have almost become like the corporate sort of behaviour standard setters. And it's not necessarily just around activism, but just any poor behaviour you see by a CEO or whatever. It's often the industry funds that are in there calling for change, and it's the industry funds themselves. It's the proxy advisors that work for them. Your Ownership Matters, AXI, and then it's people like Raz who maybe invest on their behalf sometimes too, and stay close to them, or perpetual advising CBUS what to do, that sort of stuff. So I think, like, from where we sit, that's been one of the biggest changes in the past 10 or 15 years about who's got the power in Australian equities, who's making change happen. If John Pearce at UniSuper calls up Westpac chairman and says your CEO's got to go, CEO's going to go.
And tell us about, from your perspective, the way in which both of those groups, industry funds and proxy advisors, are engaging around change, particularly through the lens of you as a media participant. Is there anything particular about how they go about things, or in the case of proxy advisors, the way in which some of their research is used, or the way it influences outcomes?
They're all different, but you'll see, like, Hester is straight out on the front foot, right? Like, you can call Debbie Blakey and get a quote about, about whatever you want, right? That's their strategies to be out there, be visible. But I think the proxy reports themselves, they're probably more weaponised by companies than they are the investors. So often, look at Santos going into their AGM or Woodside going into their AGM. If there's an activist sort of situation around it, a vote on the say on climate or whatever, and a proxy firm comes out in support of the company, the company can only send it to us, can't send it to us quick enough, like they're very, very keen to use them. So I reckon, it's companies that are weaponising those more than the actual investors.
Investors themselves. Yeah. Raz, I'll come back to Will on a tangential point in a moment, but I remember when I was a knee-high journalist, and Ian Harding at Colonial First State was the man in the market, and before that there were predecessors of his. So it's been a real sea change in the participants in the market, and so on. And how do you see, and also the role of proxy advisors is obviously vastly more important and influential than it's ever been, partly for the reasons that you talked about, two strikes rule, all the other sort of regulatory processes that are in play today. How do you see, the role of proxy advisors in the broader context around being an active investor and activism itself?
Yeah, I've kind of tended to put myself at the deep end. So I was involved with the Climate Action 100 on the CTAP for Woodside, which is, there's no other thornier issue than that. So, but I do it because I learn and I go, let me really understand what everyone's thinking about and just get myself kind of into the entire process. And it's always hard, and I know Will talked about kind of trying to degrade a force for humanity to kind of get out of fossil fuels and stuff. I guess you've always got to take a balance. The thing that I find the most useful is there's a lot of legalese and a lot of REM reports and stuff, so it's actually helpful to have an advisor read through it and come through and just kind of detail it in a way that we can, you've got basically another set of eyes looking at it. We tend to vote on our own, like we use obviously ISS and Ownership Matters and AXI and stuff, but we tend to kind of make sure that we understand what the issues are. I think what we bring to bear, and that's why a lot of clients actually like us, because we're good at engaging and understanding the nuances of the issues. Because typically when you know the company well, and this is without saying with Mark, like like when I look at Woodside, I look at each of the entities and I go, I understand this is the issue. I mean, there's like right and wrong, and mostly the truth somewhere in the middle. And we try and kind of move in to try and help management understand that these are the issues that you need to kind of deal with. And then more often than not, unless it's like something that we just completely disagree, we'll give them a go. Like for instance, at the Woodside report, we actually voted for the climate report, even though it had less than a 50% approval. And for me, the point was that they'd come a long way from where they started. They started from a really bad place. And I think and shouting out to Meg, I actually think she's one of the highest integrity CEOs I know in Australia. She's very straight. And so you might have a different view to her about gas and all of that stuff. But I think where people have made effort, we will recognize that, because a yes-no vote on the climate thing, to me, doesn't kind of, like, we're in this journey. Like my view of life is people make mistakes. I mean, Rio made a mistake with Juukan Gorge. I'm not condoning it or whatever, but you want to see what they've done to improve it. Because that's our theory of investing, that as companies get better, markets will respect that and share prices go up. So it's the same with the environmental side. As companies get better.
Yeah, it's an interesting point, because it comes back, I think, earlier, Will, to what does success look like? Because in many respects, where you would start from as a I guess where in an ideal world the company would get to, or otherwise sort of. So how do you measure success in affecting change, knowing that the perfect outcome that you may wish is not achievable? I mean, maybe that's a sort of a crude way of putting it, but I think you know where I'm coming from.
Yeah, I mean, success overall looks like policy and strategy shift that brings down real-world emissions and projections of future real-world emissions. What that looks like in individual engagement is, I think I've said this to you before, that the best shareholder resolution is one that we never have to file. And the second best is one that we file and can withdraw. We don't get a kick out of filing resolutions. They're a hell of a lot of work for us as well as everyone in this room. We get a kick out of the shift in corporate activity that safeguards investment in that company for the long term and safeguards the planet and society as well. So that's what we're there to do. We're not there to file resolutions for the sake of it and have these battles. We want to see these changes as efficiently and easily as possible, and hopefully that avoids a resolution, and it can be done through engagement.
So rather than me focusing or asking you for a case study illustration where it's been the conflict and maybe a more contentious situation, could you give us an example of where you've engaged with an Australian listed company and actually felt that there was a constructive dialogue and there was an outcome that may not have been perfect from your perspective, but was, to Raz's point, a step forward in terms of what you think is the right pathway?
Yeah, really good question. I think this will probably illustrate a little bit of what I was talking about. Commonwealth Bank is probably the one most recently that anyone who knows market forces knows that the big four Australian banks have been the centre to our work for the whole 12 years that we've existed. And we've filed many resolutions and had many engagements with those banks over the years. You may have noticed we haven't filed a resolution with Commonwealth Bank over the last 2 years, and we have been on the other big four banks, or the other three of the big four. And that is because a policy update from Commonwealth Bank, which we engaged with them a lot over the years, but particularly in this lead up to the 2023 policy update, set a new benchmark for the Australian banking sector. I won't go through all the details, but we've published a lot on it. It certainly isn't gold standard. It's not everything that we need it to see, but it was a significant step forward that demonstrated, firstly, that they were ahead of their peers, but also that they had some very clear frameworks that they will be working within when making future lending decisions. Then we said that there were gaps remaining and we wanted to see them addressed in 2024. And through that engagement, again, as the disclosures came, we saw disclosures around what the impact of that policy shift had actually made to the bank's lending decisions. So we saw exposure to upstream oil and gas halve within a year, and actual disclosures that that exposure reduction had been driven by decisions not to participate in particular deals and with particular companies. So we're not just seeing, on paper, the policy improvement, but then disclosure around how that's actually influencing activity, which is a genuine marker of success. So then we didn't file in 2024 as well. There's still gaps to be addressed, and we'll see where it goes from here. But that's I think a good example of that progress over time.
And thinking about that point around, is there an intersection between value-based and values-based activism? Would we agree that the AGL demerger situation was such a case, or were they two things running in parallel, if you like, that just happened to land in a similar place?
I think this goes to the point that I made earlier, that the overlap is significant. So regardless of where you're coming from, and the AGL, perhaps I can't speak to the motivations of everyone involved in that instance, but there were those that were coming from a pure value and those that would be more likely to be sitting in the values camp. But the overlap was so significant there and so clearly articulated through the research and the analysis and the justification that was put forward through that campaign, that it was clear that the best outcome for the climate was also the best outcome for shareholders in, over whichever term you were looking at the investment horizon.
Yeah, that's great. And Anthony, do you have a take on that?
I'd say that one is where probably the best example of where value and values have collided.
Yeah.
And that's what made that situation so explosive. That's why you had this huge campaign by Mike Cannon-Brooks on the values side. But the demerger itself was probably actually scuppered by a couple of the value investors, Rhys Birtles at Legg Mason and those real sort of pragmatic value-based investors, the ones that talk about capital allocation, doing things to unlock shareholder value. You had them both for different reasons, I think, pushing in the same direction. And that's why the demerger got blown up. That's why the board pretty much all resigned. And I think Woodside's CTAP vote last year was another one where you had this collision of the value and the values investors as well. So maybe it's becoming more of a trend. But when they do, that's when these activist type situations really get to the next level.
I would agree with that. I want to sort of, finish up with a question for each of you. And that's, I think, partly to an extent sort of where you're sort of thinking, Anthony, looking forward, where do we see the trends going in terms of activism in this market, but also the particular themes or otherwise? I might do it in a different order here, and obviously transition planning has been a big focus in many respects. If you were to call out what your expectation is in terms of where you're focused on over the next 12 months, could you give us a sense of that?
Yeah, I guess for Market Forces, it's not a trend but a mission, so it's pretty clear where we're going to be focusing our attention, and it is on transition planning, and also, I guess, the flip side of that being the cost of inaction. And so the physical risks are already starting to materialise at this level of warming, and the sort of projections of the economic costs across portfolios, but also to individual companies and assets, is quite staggering. And so I think that continuing to push for further disclosure and accountability, and then capital alignment to ensure that capital is not being expended on strategies that are misaligned with where we need to get to in terms of climate action, because that exacerbates both transition and physical risk. I think that one point that I would make on top of sort of continuing down those pathways is that I think the Woodside CTAP vote and the sort of inadequate response to that, and the fact that Woodside has continued to invest in LNG expansion with the Louisiana acquisition and things like that since, it's another example that perhaps advisory proposals, there is a limit to their effectiveness, and it is really the limit based on how a company responds. And so I think we are going to see more and more escalations through REM and director votes when companies are not responding to engagement or advisory votes.
Okay, thanks. I mean, Raz, looking for a perspective, but perhaps through a different viewpoint from you, do you expect, when we talk about the structural changes that implicitly are leading to a rise in either long-only traditional funds seeking to be more active behind the scenes, occasionally above the parapet, also activist dedicated funds as well, should we anticipate we're going to see a continuation of what we've seen over recent years? If so, are there any particular areas of flashpoints that you would think are out there in terms of either specific situations or themes, or what are companies doing that are particularly agitating to the market in terms of either not listening or otherwise?
Yeah, it's interesting. I mean, every day is different, to be honest. So it's hard to crystal ball and see where it's going. I just think that we've come out of this period of COVID where what we've seen is, the businesses that have navigated that stuff well have basically got disproportionately rewarded for it. And then there's a whole bunch of other businesses that have basically been through a tough period because of the COVID and the post-COVID, and they're just basically in a room full of mirrors. And so we're getting to this place where it'll be interesting to see what happens, and then overlay that, which is my biggest bugbear, which I think Anthony knows about, is I think this country is being run using focus groups. So today the focus group tells you that cost of living is a problem, so you come after Woolies and Coles. Tomorrow it's insurance, so someone says break up the insurers. And I think that they have just made investment environments so toxic, both sides of politics, that until that goes away, I think it's really hard for companies to step outside. But what you're also seeing, and I think we've seen recent instances where companies are so sick of the status quo, Meg going off to buy Tellurian in Louisiana and stuff. So I think people are almost saying, status quo can't continue, let's do other stuff. And I think that's a dangerous place for capital destruction, which we are seeing like a lot of. And that's my biggest fear, to be honest, because if you go back to our end goal, ultimately you want to be able to husband the capital and get the right outcome on the other side. And I think, to be honest, I know it doesn't sound very optimistic, but that's where I fear the most. And that's where I think that as shareholders, and Anthony's probably going to love this, you're going to see a lot more of that stuff hit the newspapers, where we just will not let us get run over. And that's really, and it's not because, it's because we care. And I think that's, I feel like that's something that's on the way forward. But obviously we got an election. I mean, we got, if you get a minority government and stuff, I think it's pretty tough. Because typically when the Aussie dollar is at 62 and the world's in a bit of turmoil, I'm surprised that not many more companies have been picked off, because Australian businesses are, in the overall scheme of things, very well run, and they're good businesses and they're good market structures, and yet we haven't seen a lot of acquisition, M&A activity, and to me that's been the biggest surprise.
I've seen a few Australian listed companies moving away from this market.
Yes.
And look, that's another topic altogether, which should be fascinating to pick up with you, maybe separate to this, but just the role of the Australian capital market and what it's looking like in terms of its composition.
Yes.
As you have M&A and all of those things that have been going on.
Yeah, on one hand you've got people like Light and Wonder trying to come in here because we're just stupid. And then there's a bunch of guys going overseas because you want to get paid. So it's kind of like, it's a very heady mix. So, I've spent more time talking to boards in the last 6 to 9 months than I have probably the previous 5. So it just tells you that people are just losing their mind, I think, in Australia because of the regulatory, and we saw that with the ACCC on the supermarkets and stuff. And it's it's like when the insurers reported recently, it's almost bad to make profits. And I just don't think I'm a migrant. To me, it's just wrong. These companies, the insurers have taken so much. We talked about insurance and physical risk and transition risk. They haven't made any profit for a while. And then, when IG and Sun come out with good results, both Steve and Nick are going, don't look at me, let me hide. I just don't think that's a good, we have to celebrate kind of capitalism, and I just think this country is just going the other way.
Anthony, I suspect there's a few points there resonating with you, but in terms of, and you don't have to keep, it solely to the activist dimension. I think we're all interested in your views around what we should be expecting in a broader context, such as what Raz just spoke to us about, but equally in capital markets itself. So what are you hearing when you're talking with CEOs and chairs and dare I say it, one or two investment bankers?
Yeah, well, I think just firstly, your question about activism, I think we're obviously going to see more of it because you've got these funds that have come in, they're all reasonably new entrants, your L1, your Perpetuals Activist Fund, Tanara. They've raised money, they've got to do stuff with it, right? So they are going to run more campaigns. So, you think that's going up. But for me, they're a little bit of the side issue. I'm actually more interested in your Razes of the world who, they're not activist investors, but you're talking about, your willingness to write to boards, to engage with companies, to sort of be part of, to try and get inside their head and try and push for change. And I think with the structural change that we've seen in capital markets, like you've spoken about with the rise of passive investing, the rise of the industry super funds, those active managers are playing, such an important role in sort of getting involved in companies' heads, in trying to keep them honest, in trying to get them to think more about capital allocation and maybe question that offshore acquisition, a little bit more closely than they have in the past. I'm really more interested in probably those active owners than the activists themselves, because I think that the motivations are sort of more pure, more long-term. It's not just trying to make a quick buck on a quick activist situation. I know there's this Whitehaven case study coming up next, and that's actually one situation that I thought probably wasn't worth engaging in, just because you have this, it was run by a hedge fund out of the UK, wasn't willing to get on the phone and talk about it, wasn't willing to disclose the position. It was CFDs, swaps. It was really hard to actually get to the bottom of their motivation. We're probably more sympathetic to the tried and tested funds where we're confident they're actually pushing for change for the positive, not just trying to make a quick buck.
Great. Well, thank you, Anthony. Thank you, Will. Thank you, Raz. I think everyone would agree that was a very robust and we covered an enormous amount of territory, but very enjoyable discussion. So thanks, everyone. And thanks again to Eric for asking us all here.
Thanks very much, Brett and panel. That was a fascinating conversation. Thank you very much.